Joining us to explain is Tom Lee, the CIO and head of research at Fundstrat Global Advisors and a CNBC contributor. Tom, are you thinking through this in sense of kind of what path tariffs are ultimately going to take, or can you kind of look beyond that now at some point and just say it's just not going to amount to enough that it derails the market from rallying?
It's a little bit of both. I mean, I think in the near term, of course, the visibility on tariffs has gotten messier because now we have the judicial system weighing in on what can be done and the response from the White House. But because I think the scope of what can be accomplished with tariffs has actually shrunk, it means when we think outside the next couple of months, I think that ultimately it's pushing us closer to a resolution, because now the bid ask between like what other countries might accept versus what the White House is trying to achieve is actually shrinking. And that gets us closer to the end game. So I think this is actually a net positive for stocks. And I can understand why markets are confused. But to me, I think the equity risk reward is still better today than it was in February 2025 when the S&P was at its old highs.
Right. So, I mean, in particular, do you look at the chip rally? Do you look at Nvidia, which is, for what it's worth, kind of coming back down to earth after that big rally on the heels of its earnings last night? I mean, is that where you would look to kind of press into, or how do you think about what the rally might look like between now and year end?
Well, I think that when markets really believe the tariff sort of story and saga is behind us, I think it's going to be a very big cyclical rally. So I'd be expecting industrials and financials and tech, especially the washed out tech, which includes the Mag 7, to really lead. But I also think that would include small caps, because small caps have really been hammered by all this economic uncertainty. And so once that visibility returns, and then we think about 2026, and that's probably when the Fed is, more dovish than they are now. That's a tailwind for risk assets. So I actually think, weakness here should be bought, and I'd still be buying dips.
We got a combination. We know all of Wall Street's really just reading Fundstrat, Tom. We get that. But they also sometimes publish their own stuff. So we got kind of a collection of a lot of comments this morning. Barclays said this, and I thought this was an interesting take, and then you can respond or not. It is not clear this is a catalyst for a sustained new risk on, given the complications it could pose for tariff revenues, the tax bill, and the bond market. And the point I think they're trying to make is the tariffs are supposed to bring in all this money that could influence how the tax bill ends up. And, of course, that could influence the stock market. So if the tariff money goes away, even temporarily, does that impact overall D.C. tax policy and thus the equity market?
Well, I would chalk that up to another piece of a wall of worry. Over the last couple of weeks, as markets rallied, our macro clients have actually been really fighting this tape. They've been very skeptical of stocks rising, and we can see it in the prime brokerage data where gross is actually high, but net is low, meaning hedge funds are shorting this rally. And we know there's still a lot of cash on the sidelines. So investors are looking for excuses for the market to fall. I mean, I'd say even that interpretation from Barclays is just another good example. I mean, previously we didn't want high tariffs. Now someone's arguing that if tariffs are lower, it's bad for the fiscal situation. I almost think someone's trying to say heads I lose, tails I lose. But at the end of the day, if we get a tariff resolution, that's good for stocks. And I think companies survive this gauntlet of terror. That's why multiples should be higher next year.